Good afternoon, ladies and gentlemen. Today's session is on the record, and you may engage with us using the hashtag ACE Energy Forum. ACE Energy Forum. Today in our session, we will shed light on the year and the energy to come, offering insight into the oil market developments and follow and given guidance on how to interpret them. We will also be talking about the energy market landscape in 2018, what trend should be watching for, and which developments show the most promises and could bring the most disruption. Our panelists today are Mr. Ayman Asfari, Chief Executive Officer of Petrofac, Ms. Meg Gentle, Chief Executive Officer of Tellurian, Mr. Hunt L. Hunt, Chairman and CEO of Hunt Consolidated Energy, and Mr. Majid Jafar, Chief Executive Officer of Crescent Petroleum, Mr. Young Ho David Kim, Chairman and CEO of Dyson Group, and Chairman of the World Energy Council. I'll start the session actually by asking Mr. Asfari, when we look at the stronger oil price today and the healthy global growth in the energy market as we start this year, what is your outlook for the energy market this year? Where do you see the most challenges, opportunities?
I come behind very prominent speakers that talked a lot. I'm probably the only member on the panel who represents the service sector. So I'll talk about the outlook from a service sector perspective. What we've seen in the last 3 or 4 years, first of all, I have to say that when we talk about the energy challenge, this is a challenge for all of us working together, whether it is the service sector or the producers. We're all putting together the capability as well as capital in order to meet the demand for energy for our consumers. So there shouldn't be this very big division between the two. But if I look at the sectors for the last 3 or 4 years, we've had a massive reduction in the cost that frankly has been imposed on the industry as a result of a reduction in the commodities. Some of these cost reductions were good because they resulted from alignment with clients, from looking at innovative ways to work, from deploying technology, using standardization, and also some of the underlying commodity costs that has come about. But other cost reductions came as a result of severe contraction in the margins of the service industry. And in many cases, those who deploy assets, frankly, having no return on their investments. We've seen the oilfield service sector, the decline in the market value of the oilfield service sector from the end of 14 to end of 17, something around 35 to 40%, whereas the major oil companies decline in their share prices with about 15%. So I think we suffered as a sector a lot more from this decline. For me, I think the biggest danger that I see in what has happened in the last 3 years is the sector has lost about 230, 250,000 people. And this is a huge amount of talent that's gone away. And we're seeing now, for instance, that with the recovery in, say, completions in the U.S. business, there are lots of spreads, but there's no manpower. And we've seen an increase in the prices as a result of the fact that many people decided this is not a business I want to work in, and they've gone to something else. So I see this as a very big challenge for the industry, and it's unfortunate that we've had these booms and busts. But this to me is something that we have to collectively address as we move forward in with hopefully more moderate or healthier prices.
And if we assume that the oil price will continue trading around 65 to 70 a barrel, do you actually foresee more consolidation, or we have passed that stage and we could see more investments in the market?
To be honest with you, the consolidation in the business, we've seen a lot of consolidation in the service sector in the last 3 or 4 years. Consolidation is easy because to take out costs, because you take out the SG&A, the combined SG&A. So this is a very easy, quick reaction, quick fix. We're yet to see many of these consolidation create value in the long term. Many of these mergers, ultimately, they don't create value. So particularly in people businesses where you bring businesses with different cultures together. Having said that, I think at a stable price, hopefully the two things the two very promising things that I see happening is I think with the stability in the price, we can have a better dialogue between the service sector as well as the producers to create a way of working that is a win-win way where we can think smarter and we deploy our resources collectively in order to achieve the objective. And I just read a piece in the Oman Observer. We have His Excellency Omani Minister here. PDO's MD talked about the alliance that they had with us and how, as a result of this alliance, we've developed projects worth a few $1 billion with them the last few years, and we realized hundreds of millions of dollars of savings by working in a very transparent and efficient way together to create this win-win way. I think the other thing that I see, which is extremely promising for the future, is really the role of technology. I think technology is definitely going to transform our business. I mean, the data mining, remote working, simulations, all these new areas, and we are obviously embracing them. There will be hundreds of billions of dollars that could be taken out of the business by deploying technology effectively. So I'm hoping that with a stable oil price, without having to overreact to the service industry and to frankly bash them to say you just have to cut, and in many cases, drive people out of business or not generate any returns on investments. I'm hoping as a result of this we can have a more constructive discussion to see how we can create a win-win way of working, as well how can we deploy the technology in a way that creates value for all.
I'm going to move to Ms. Meg. As a reporter, I've been personally very interested in the U.S. market. I think it took everyone by surprise for the last 2 to 3 years at least. But the question is, what are the key challenges that are now facing producers like you? Area of growth. Have we actually seen the climax for oil producers and gas producers in the U.S., or this trend is going to continue for this year?
So definitely somewhere to the contrary. I don't think we've seen the climax of U.S. production, and in fact, $70 oil environment is a much more stable environment for drilling for oil in the U.S., which provides the perfect conditions for gas prices in the U.S. to continue actually decreasing. The more oil drilling that we see in the U.S., especially in the Permian Basin, the more associated gas production we will find, putting more and more downward pressure on the NYMEX price. We see today that we can produce gas in the U.S. for less than $1 an MMBTU. And after we transport it to the Gulf Coast and pay for the cost to liquefy it, we can bring it to the world market for $3 an MMBTU at the beach and $4.50 an MMBTU delivered to the market areas. So this means that 2018 really is going to be a banner year for decision-making on the next wave of LNG infrastructure. And as we look, frankly, at the U.S., a lot of the increased production is happening in different areas from the traditional infrastructure. So there is a lot of investment that is needed in natural gas infrastructure. We foresee about $170 billion needed to bring the next 20 BCF a day of gas production in the U.S. to the market. And after that, it's really simple. LNG is starting to be an adult commodity, and with the commoditization of LNG, markets and buyers can get a cargo of gas anytime they need it. So it's bringing a lot more flexibility to the development of the industry.
Last year, particularly towards the end of 2017, we've seen a significant moment, I would say, in the oil market. We've seen companies like Saudi Aramco going to the U.S., talking to producers about actually investing in shale, something that no one had expected or anticipated 2 years ago. Do you see more traditional Middle East producers coming to you, coming to others, either looking for assets or expertise? Is there a trend there that we need to watch out for?
So this is a very important region for the future of the LNG market. A lot of growth in LNG demand on a percentage basis, potential for the market to be more than 20 million tons of LNG just in the region. Clearly, it's an important region for Tellurian. That's why we're here for the conference. And we're trying to design a different business model. So, a lot of talk this morning or earlier today on the panels of changing the business model, reducing the costs, innovating with technology and other things. And this is what we're trying to do at Tellurian. We have about $25 billion of capital that we need to invest in the infrastructure that we're trying to put together. And we're looking for partners to do that with. So as we look for different ways to build the infrastructure, partnership really in an integrated value chain is going to be important to reduce costs and always have flexibility and profitability on the margin in a commoditized business.
We're going to stay on the same topic, so I'm going to go to Mr. Hunt and ask him to talk to us more about the U.S. shale evolution, where we stand today, and where do you see opportunities?
Sure. So I do think it's absolutely a true statement that as prices go up, you'll see more shale production. But I think there's a view held in the rest of the world that is maybe a little too simplistic around that. When the price collapse occurred, there's an expectation, I think, that you'd see a lot of the shale producers throw in the towel. And in fact, actually, the production in the U.S., as everyone knows, stayed pretty robust. But if you really start to dig into the numbers, a lot of the shale revolution is really the Permian revolution. The Permian Basin in Texas has been prolific and profound. But you've seen in a lot of their shale plays, and we're in the Permian, we're in the Bakken, we're in the Eagle Ford. You don't see the same growth coming back in the way that I think people had once thought. There was a boom, there was a bust. You never bet against technology, but you absolutely should bet against the last boom. I think a lot of the capital providers have decided that they want a different type of relationship with a lot of the independents that they've been backing, and they're demanding more return on their capital as opposed to just simply growth for growth's sake. So I guess I would fall a bit more on the skeptical side of just how long you can run out the projections of shale oil production in the U.S. and the growth that's there. The best analogy I could use with the shale plays in general is a lot like the airline industry, where since Orville and Wilbur Wright took off, the airline industry in totality has destroyed capital. It's lost money. It's lost more money than it's made. And yet there's more, there are more planes going to more places, more airlines with more seats, with more people at a lower cost than ever before, and some can make money. And it would not surprise me at all if 15 years from now they do a 20-year look back, and in totality we have more oil and gas producers producing more oil out of more wells and more fields at a lower cost than ever before, and in totality the industry has destroyed capital, and yet some will make money. So I do think there's a regulator on just how much the U.S. shale can actually provide to the rest of the world to keep prices in the $60 to $70 range.
So it is here to stay, unlike, I do remember a few years ago when I went to one particular oil minister in the region, and there was skepticism around shale, I think. Everyone thought it's not going to be the North Sea situation. If prices drop massively, they cannot adapt. I mean, I am interested how low, or basically what is the threshold for U.S. shale producers that they would stop growing? Like, we're talking 30, we're talking 40, because I don't think actually Middle Eastern producers, particularly OPEC members, have managed to agree on what would be the price that will kind of slow the growth of shale.
So there's a snapshot answer to that. There's a movie answer to that. The snapshot is kind of with certain price thresholds and where we are today. And you saw this play out throughout 2016. The Permian really never slowed down. West Texas really never slowed down too terribly. It was dampened, but you continue to have activity even at the bottom of the cycle. When you look at the Eagle Ford, the other shale in Texas, and the Bakken, there's a profound impact on those plays from an oil perspective. And so there are, for lack of a better word, kind of threshold prices. You saw the Bakken start to slowly revive in the $50 range, but it's picked up considerably now that we're pushing $60 and above. The Eagle Ford, you've had a very similar response. There are new plays that are out there, the Stack and the Scoop, and so let me be clear. I do think you'll continue to see an increase in U.S. production from the shales, but it's very uneven across the different basins. And as technology continues to evolve, you'll continue to see some prices fall, but then on the services side, I think the service industry would argue we were in an unsustainable position back in 2016 and 17, and so those costs will have to come up, and that will have an impact on what the break-even cost is to the U.S. So I think it's difficult to envision a world with healthy shale plays below 50 in general in the next few years. I don't think you'll see some of the more rosier projections of what's out there, the $70 world. I tend to be a little more skeptical of.
I'm going to go to Mr. Jafar. The big question is natural gas for the Middle East. I think everyone has oil. The UAE is trying to increase their natural gas production. Saudi is really trying. Iran, Iraq. Where do you think the potential growth, and what's your outlook for production here in the region?
So, it's clearly a very important question, and it can't be disconnected from what's going on in the rest of the world, and in particular, what we just heard about, the phenomenal shale revolution in the U.S. I remember working for one of the majors back in the late 90s, early 2000s, and the assumption in the industry was wherever you could produce gas in the world, you could send it to the U.S. It was a sink. And nobody imagined that, here in Abu Dhabi, I'd have colleagues on the stage who are competing with producers here in the region and exporting LNG even to this part of the world. Preparing for this panel yesterday, I thought I'm going to be on a panel with some, knowledgeable CEOs. I better do my homework, so I started channel surfing news channels, and two things hit me. One, which everybody's talked about, oil hit $70. Another, which I haven't heard, at least in the plenary session, which really shocked me, and I do want to highlight it as a trend to watch out for, was the city of New York and Bill de Blasio not only disinvesting the New York pension fund from oil and gas, but suing the big five oil majors for the damage caused by the hurricane to New York City. Let's put that in perspective. The oil and gas sector is now being targeted to be blamed for climate change like the cigarette companies were for cancer. And it's some of the same army of lawyers and lobbyists and all the rest of it. And it started a few years ago. People like Dan Yergin were warning us that university campuses and endowments are getting out of this sector. And that's now happening. And I've been warning my colleagues in the sector, they're not doing enough to get the message across about the role, the important role, fundamental role of this industry in tackling climate change. And we do need to, as Bill Clinton says, look beyond the headlines and actually look at the trend lines. I believe in climate change, absolutely. I'm really concerned about it. But we're not going to get there with slogans and politics.
Sure.
We have to actually look at what works and what doesn't work. And to work, it has to be sustainable economically and environmentally. I mean, we heard from the German State Secretary all about electrification. Germany's carbon emissions have risen for the last 3 years. And he's talking about electrification. Almost half their electricity comes from coal. So what's the point of an electric car if half of them are coal-fired cars? The United States, on the other hand, because of the shale gas revolution we've just heard, has the lowest emissions since the early 90s, the lowest per capita since the mid-60s, and in terms of emissions per point of GDP, the lowest ever. And in UK, similar. Because of gas replacing coal, the UK's emissions are like the lowest since Victorian times. And yet, the man on the street, because of this kind of anti-fossil fuel agenda, groups them all in one bucket. The oil and gas and coal are somehow all the same, which is nonsense. And the fact that, oh, it's the cheapest ever. Again, we heard from the UAE minister, you need to look at availability, and you need to look that you have to back it up. So the UAE's energy policy, and most governments don't have forward-looking energy policies. We heard last year at this meeting, he announced the UAE one, looks at equal natural gas and renewables, because they're actually very complementary. The other thing is looking at use of power. We're talking about oil. Oil demand is not driven by electricity. I mean, we're mixing two different things. The oil demand, as we heard from Fatih Birol again here last year, is being driven by freight, trucking, air transportation, shipping, and the fastest growing sector is petrochemicals. The smartphones you're looking at, the screens you're looking at behind me, so many products that people just take for granted are products of this sector. And people are not understanding that. And it's concerning because we're not actually going to be sustainably and properly tackling climate change. I mean, everybody seems to think that somehow Europe is really good and the US is really bad. Maybe in terms of what's said by the politicians, but if you look at actual emissions, it's the other way around in many cases. So for us, coming back to the Middle East, I think we need to learn from what's happened in these major economies. Having a forward-looking energy strategy like the UAE has laid out is key. We have half the world's oil and gas, and yet a third of oil exports, a sixth of gas exports, so we're punching way below our weight. And we have a lot to be done to be able to achieve our potential, and that is better investment models, including a much bigger role for the private sector. And we heard Dr. Sultan talking about being more creative in the type of partners. That's in tackling energy subsidies to achieve the real prices, which the UAE minister mentioned, because without those you won't be able to justify the investment. And as Fatih Birol said, trying as much as we can to have the happy divorce between the energy, which is so key, I mean, it's the lifeblood of the economies, and the politics, because our region clearly suffers from a lot of conflict and geopolitics at the moment. But that changes from day to day. When you're talking about energy investments, you're talking about 25, 30 years. And so you need to be able to make those and not have them affected, or at least minimize the negative impacts of the geopolitical instability.
You mentioned that we need to create better incentives and framework for the private sector to play a bigger role in the energy market. Where do you see the most opportunities in, is it in Saudi Arabia, is it in the UAE, is it in Iraq? Where, you as a Crescent Petroleum, where are you looking at the moment?
So, in our region, and we can't ignore the history, our region went through colonialism and in the collective consciousness of our people, abuse of our natural resources by Western powers. So we came to the 50s, 60s, 70s with nationalization and countries retaking control over their sovereign natural resources. And the focus became national oil companies and mainly focusing on oil. So there was underinvestment in gas, there was underinvestment in exploration, and there was underinvestment in oil products and refinery. So we actually have to import a lot. So I think the recognition now, with the strain on government budgets, is the need for cost efficiencies. And Dr. Sultan is leading a huge transformation of ADNOC here in the UAE, recognizing that if you can reduce your costs and be more efficient, that could be an easier win than increasing production given OPEC quotas and so on. Saudi Arabia privatizing, or let's say not privatizing in terms of private sector control, but listing and an IPO of Aramco, the driver actually, if you listen to the Crown Prince's objectives, was not about raising capital. It was primarily about achieving efficiencies for the national oil companies. So that agenda is going on with the national oil companies, including tackling the subsidies. But there's also a recognition that you cannot just rely on state budgets for all necessary investments, particularly when you're looking at the entire value chain of energy, including the downstream and supportive infrastructure and exploration and natural gas. But to be able to open up more for investment by the private sector, both regional such as ourselves and international, you need to start looking at fiscal regimes. It's not just in terms of making it more attractive, less attractive, but the structures of the contracts to be able to really attract the investment, particularly when they have other options like the US or Africa or Latin America. For us, we're from the region, we're in our 5th decade, we're focused on this region. The UAE has been our headquarters and home base and historical production. We're very invested in Iraq now, looking at north and south, other countries across the region that very interesting to us at the moment, opportunities in Oman, Sudan, Tunisia as well. So the MENA region is our focus, and there's still huge untapped potential.
I'm going to go to Mr. Kim. In general, if we look like a country like Germany, we see it as a sustainable energy role model. What about Asia? We're seeing a lot of growth. They're one of the largest buyers of crude from this region. Can Asia become a role model for sustainable energy?
I would say the reason why you are interested in Asia is because now Asia is playing a very pivotal role at this point of tipping point. To be in it, I have to tell you that I'm invited here as the chair of Daesun Group, which is the oldest and one of the largest gas company in Korea, providing about 20% of residential market with our gas. Also, I'm a chair of World Energy Council, which is multi-energy and multinational organization with 93 member countries. But the fact that I'm from World Energy Council is, I tell you that World Energy Council is from the very beginning a very apolitical organization, because we started our organization to rebuild electricity infrastructure after the World War I. At the time, the electric community has a certain camaraderie, like the blockchain community in these days. They certainly have apolitical camaraderie to rebuild the infrastructure for whole Europe. That's how we started as a global power conference, and we transformed into this World Energy Council. So we still keep that tradition of apolitical forum. So I don't have to worry much about politics when I speak in World Energy Forum. But when I stepped into this room, I saw the diagram which showed me the foreign policy and energy. And I immediately recognized that I'm in a different turf. This is openly political forum. So to remain politically neutral, I have to be probably extremely political so that I can still remain politically correct. And well, having said that, I feel like why do we care about oil and gas price? Why do you care? We are businessmen, or some politicians and some scholars. Why do you care? We are not speculators. We cannot lead the market. We are here to respond to the market. Any responsible businessman are supposed to respond to the market for the commodity like oil and gas. No one can lead. I think history will say that the stance OPEC is taking now, setting a target for oil price and harmonizing the members and even reaching out to members to bolster the oil and gas price, will be recorded in history as the last attempt for any organization or some powers to bolster the price of commodities. I think it's almost inevitable that with such a drive for the renewable energies, I don't think this price, in a way, I wouldn't say this is abnormal, distorted, but I would say this drive to bolster oil and gas price can be sustainable. Well, am I still correct politically? And when the price of oil went to the $147, the chair of the member committees of the World Energy Council was also the chair of the NDRC, a vice chair of NDRC, which is the most powerful economic organization in China. And I discussed with him to bring the five energy ministers from China, Korea, and India, and America and Japan to discuss the unusual hike in the oil prices. And the G20 ministers joined the discussion. And then at that time, I saw that when $147 was recorded, the demand for oil was 1% larger than the supply. Just 1% difference doubled the price from $70 to $147. And when it went down to $130, I already saw that the demand and supply was reversed. 1% short, the supply was 1% larger than the demand. So I was very optimistic that the price will come down. So I was invited to one business conference, and I boldly said that price will come down back to the $70, even to the $30. And then one of the journalists there was so surprised that he reported in the newspaper. But actually, it went down to even the 30s, I think you might remember it. And so 1% difference means a lot in commodity. And so I'm not quite sure whether this price, $60 or $70, can be sustained even after Aramco IPO. And I've said too much already. But again, I said that why do you care about the oil and gas price? Why do you care? Probably we are speculators. You will be very urgent issues. But I'm a businessman running gas companies. I don't care much about that. Oil price goes up and the gas price is paired with oil price. And we have some good time because the oil it's more expensive than gas. And then it comes down and I don't care. And I think, Mr. Hunt, I think you will not care much. We might respond to that, but you will never attempt to lead the market, right?
Although we like the higher prices. But yes, you're correct. Yeah.
So when I go to the energy conference, even World Energy Forum, people are very concerned about price of oil and gas. But frankly speaking, I don't care much about that. It just follows the demand and supply of the market. And what we have to be concerned is not oil and price, gas price itself, but the grand transformation, if you will, which is that now energy industry is transforming from resource-based and capital-intensive industry like a Hunt company into the knowledge-based and the very technology-intensive industry like Tesla. So now the the picture is changing very rapidly. And with the advent of battery industry, commercially viable and more advanced, I think Asia can lead the whole energy industry in the future, because now the top 7 battery producers are either from Korea, China, or Japan, which supplies battery market, 90% of battery markets. No one in the United States compete with them. And also the solar cell producers, 8 of the 10 largest solar producers are from either Korea, China, and Taiwan. So now, in a way, Asia will lead in this grand transformation. So I think when you're talking about oil and gas price in the long term, what you have to be concerned first is demand and supply. That's very basic, but that's very telling indication. And another thing is that technology, the grand transformation, which is proceeding very rapidly in the market.
Now I'll be handing over to John, who will be taking questions from the floor.
Yeah. We don't want you to leave the stage.
No, I'm staying.
There, yeah. There we go. Thanks very much. Do we have any questions from the floor, first and foremost? I have one for the chairman, who just suggested we don't really care about the price of oil, but it's going to challenge others on the panel to jump in on this. If we do see these wild swings with oil prices and with gas prices, wouldn't it kill off investment? There's a pretty strong debate right now that there's a lack of investment in fossil fuels, which is going to boomerang and even drive the price even higher. Majid, very quickly, and then we'll come to the others on the panel. Please jump in when you see fit. Go ahead.
So I think the concern is the second point that you mentioned, that there's still a real concern. There's been so much underinvestment in the last few years in terms of total capex, in terms of FIDs, that this rise up to 70, yes, it may come down by the summer, but in the next couple of years we could see a dangerous spike upwards if that isn't restored. And my reason for highlighting this kind of anti-oil and gas agenda and misconception out there is if the sources of capital start drying up for political reasons, then we have a real problem, not just in terms of economic sustainability, but in terms of properly achieving carbon emissions and the climate change agenda. And actually the biggest event of 2017 that I see was both China and India. I mean, I totally agree. Asia and the Middle East are the growth, in particular for natural gas. Both China and India at the highest levels taking a policy decision to very rapidly increase the natural gas share. I mean, China's growth of LNG imports has just been staggering. And again, for both of them, it wasn't because of a global climate change agenda. It was because of local pollution in the big cities. I mean, we saw what happened in India this year. Shocking. It's been happening in Chinese big cities for a long time. That's where the buy-in happens locally in these economies, is on local pollution and quality of air.
Interesting point. Go ahead.
I'd like to continue on Majid's point from before on the positioning of the industry, too. There's an American comedian, Ben Stein, who said he couldn't understand why cigarettes and the oil industry are considered the same. You can't stick a packet of cigarettes in a car and go anywhere. And I think that's actually the challenge, is energy is not like every other product. There's an incredibly tight correlation between energy per capita and GDP per capita. That relationship between human development and energy is critical. I think there's a high suspicion that comes with our industry because of that. And so when you have these wild gyrations and a boom and bust, one, it makes it very difficult, not just for the industry, but I'd argue for the broader industrial activity as well as the developing nations when you see prices whipsaw back and forth. But I think that beyond it, it becomes very, very difficult to see a situation where you can let markets migrate in a manner that fits what the underlying population is trying to do. And if I could just give one quick example, in Texas, it's a 70,000 megawatt electrical system, and this is Texas. So if you think the U.S. is bad, most people in the U.S. think Texas is quite dirty. We have 20,000 megawatts of wind with no state subsidies whatsoever. We now have more wind capacity in the state than we have coal. We've actually had 25% of the entire month of March last year, the power came from wind. Solar is now showing up. And this is all happening not because of mandates, but because markets are working. But those markets that need a certain level of predictability in order to make the investments to push forward. So energy is different. I do think we as an industry forget that to our peril sometimes. But having some price stability is going to be critical if we're going to continue to evolve into the 21st century with the energy mix that we need to have.
I was going to say the volatility is a killer. Very quick comment. I'm going to come to Fred.
Again,
Kemp.
I think from this industry, I've been in this industry now close to 40 years. This industry, and I've seen it many times, we make the same mistakes over and over again because of the boom and bust. And the decline that we've seen, we've had a 40% decline in capital spending. It had a tremendous impact on the knowledge base that we've had in this industry. We've lost, as I said, about 250,000 people from the service industry. Now, this is very, very important knowledge. So we would really not like these booms and busts because otherwise we're going to repeat the mistakes again in the future.
Okay, we have a question from Fred. Oh, sorry. Please, Meg. And then we have another question here, so let's be brief.
John, if I could just finish with a comment on the sustainability of investment in infrastructure for natural gas in the U.S. is not going to be particularly sensitive to oil price over the next 5 years because the systematic underinvestment in LNG infrastructure means that we're about to see a tight natural gas market on a global basis from 2020 and beyond. And therefore, the infrastructure investment has to happen. We're going to spend $25 billion in U.S. infrastructure upstream, midstream in pipeline, and in liquefaction, and that's not particularly sensitive to oil price at all.
Okay, very good. Fred Kemp, and then we'll come over here.
If you'll allow me, John, quick question for Meg and then for Majid. I wonder if you could talk a little bit about where you're seeing your most attractive future export market, and how are you looking at China in terms of, it was very interesting in the previous panel, the role that the U.S. is playing in LNG exports, and I'm just wondering whether how you see the Chinese market developing, particularly for you. And Majid, I wonder, with all of your knowledge about Iraq, whether you can talk to us a little bit about the energy picture in Iraq and what's likely to develop there.
Thanks. Meg?
Oh, thank you, Fred. Asia overall is about 75% of the LNG market, so clearly it contributes to most of the growth. As Majid was saying, China and India each had, I think, about a 50%, definitely over 30% growth in LNG demand in 2017. We would expect to see that again in 2018. The Chinese market today is about 35 million tons of LNG consumption, which we expect to see trending to 100 million tons by somewhere between 2025 and 2030. The public policy impact in China has been absolutely incredible. Several million homes surrounding Beijing have been converted to electricity from coal. I didn't even realize people were still burning coal in their homes. That was very elastic demand that happened when prices were low. It will be absolutely inelastic as prices go up. I don't think people, once they're converted to electricity, are going to go back to shoveling coal out of the backyard and bringing it into their home. So the Chinese market and the Asian market overall are going to be very important. And even if we have steady 4% growth in the LNG market, we need over 100 million tons of additional liquefaction capacity to be built over the next 5-year cycle to meet natural gas demand by 2025. The call on gas from the U.S., we're expecting to be more than 50% of that need. And that's in an environment where 2017 LNG demand growth grew 12%, and we expect to see that again in 2018, simply responding to the next 37 million tons of liquefaction capacity that's coming into the market this year.
Okay, good. Majid, I'm going to just be a little bit specific on the question that Fred gave because of time, so I'd ask you for a 2-minute answer. We've seen unrest in the Kurdish region, which is a huge issue, and I know you have plants in the Kurdish region itself. We know what's happened around Basra and the big boost of production. What is sustainable in Iraq? I know they have aspirations to add another 500,000 barrels a day. Can you bring the law from the Kurdish region into the national policy and have something that stabilizes? Because we were all pretty shocked what happened this year.
So in the interest of time, I'll just give a plug for the Iraq session tomorrow afternoon downstairs around 2 o'clock. And the Iraqi oil minister will hopefully be there, and we'll be also launching a great report that the council has worked on over the last year, the idea of which actually was born at this summit last year. Just high level, I would say on Iraq that despite all the negative headlines, again, look for the trend lines. Iraq and the U.S. are the sources of growth over the last year. It's a record high production and exports, despite no law, ISIS, internal fights, the Kurdish referendum, corruption, infrastructure challenges. So despite all that, we've seen that phenomenal growth. And I think now that hopefully things have stabilized on the security side, both with ISIS and the Kurdistan question, the future is even more promising. It's vastly underexplored. I would not be surprised if it had the highest oil reserves in the world once the exploration is done. We're totally just getting started, really. There are major challenges, but I think it's going to be a growing and important player.
Okay, so we have one more question from the floor. I did ask permission there. I think we're tight on time. Please, I'll just ask you to be brief.
Yes, Gianni Di Giovanni of ENI and very proud new board member of Atlantic Council. So the question is for Mrs. Megan, but she just replied, but I want to address at the same time the question because she is, with Tellurian, one of the best player of LNG gas. So we consider gas, natural gas, the best option for the transition program that we had in these years. But we have right now 3 different prices of natural gas in the world. We have a price in the United States, another price in Europe, another price in the east of the world. So how can LNG can help the normalization of the situation? Thank you.
Thanks.
So first, congratulations on the only new LNG construction project in 2017, Coral LNG. I think that LNG will help arbitrage prices across the different regions. The price in the U.S. will continue to reflect U.S. fundamentals. Just a reminder, the U.S. produces today 77 BCF a day of gas. Even if we are successful doubling the liquefaction capacity, the exports of LNG will only be at most 20 BCF a day by 2025 to 2030 time period. So imports will continue to be a small portion of the overall U.S. market, and will be ability to export will be constrained by infrastructure. So we continue to believe that U.S. gas price will remain $3 or less for the foreseeable future. But LNG, as it is becoming more and more commoditized, can serve to arbitrage the difference between Europe, Middle East, and Asian prices, where prices should reflect simply the difference in shipping cost and any tightness in the shipping market. So we really do believe that finally LNG is become an adult commodity. There are between 14 and 15 cargoes of LNG loaded every single day today. So any buyer can get a cargo of LNG. It's just a matter of price, just like the oil market. This is an absolute revolution for the LNG business to have this kind of liquidity and flexibility, and I think it's really going to serve the business to be able to expand and provide better stability and security of supply to all the global markets.
Thank you so much for your time and insight. I hope my questions were not too long. Our next session will begin at 5:15 in Maraya Ballroom, and it will be entitled Iran Sitting Strategies Amid Increasing Tensions. Thank you so much, ladies and gentlemen. Thank you. Thank you so much.